got to stretch your legs out, you know what I mean? Got to do it. Damn desk job. Hey, welcome to the Closing Beat, everybody. Happy Tuesday. How you doing out there? Welcome to our show, brought to you here from the Jazz Wealth Studios. Financial advisors that we're just normal people, you know what I mean? Like, we're just trying to do our thing here, not be stuffy, not be crazy, get to know us a little bit. You see me here every day. Fun fact about me, actually, I'll tell you the good and the bad if you want to know, about me, my life, what I do at home and stuff. The fun fact, I was addicted to the hokey pokey, but I turned myself around. Gotcha.
I hate you. I hate you for that. That's not good. It's not good.
Hey, if you want to play some games with us, go to jazzwealth.com/guess the Dow. If you're the closest, guessing the Dow, we do it week by week. So you have this week to guess where you think it will close next week. If you're the closest without going over, we'll send you a $100 gift card. If you're not a client, and if you are a client, you could choose the gift card, or we'll just credit your account $100. And a common question that I get is, does that count towards my Roth contributions? Nope, sure doesn't. Also, jazzwealth.com/2023. Just a quick little sheet. It's free. You can have it. There's no strings attached about all the 2023 numbers and everything. I like to mention that for you because, Haley put a little time into that. She was seeing a lot of questions, so she made a little simple sheet for you there, and we won't spam you or sell your email or anything. We're not big enough to have anybody really care about that, but we're happy that you're watching here today. I make some jokes in the beginning. I'm hanging out a little bit because you just can't have a more sleepy day in the stock market, right? Compared to what we've had. It's been sort of active. You have a great day, bad day, great day, bad day. Oh, what's going to happen? Today, man, I almost fell asleep at the start of the day. I was all excited. I love when the market opens. I'm like, let's do this thing. Oh, man, not much happening here to start the day. And by the way, not much to finish the day either. We'll do something that we forgot to do yesterday. We will take a look at the sector strength relative to the S&P. So if you're looking along and either a momentum player, someone likes to invest in sectors or stocks that are doing well and you just sort of buy high, sell higher, or if you're a buy low and sell high person, you like that counter trend stuff, I always like to share this with you guys. Tech continues to outperform, although that is fading away second by second here. And if you look around, your discounted areas at the moment are going to be financials, materials, real estate, though not as much and as impressive, and industrials, after really outperforming for a while, finally starting to give you a more meaningful pullback. We know that energy is pulling back because of the low prices in oil there. That's okay. Oil's actually trying to rally a little bit for you, so some energy stocks starting to wake up. And if you like basically playing momentum, your only options are tech and communication services, though I might add, there it is. I might add that they're starting to pull back for you. So if you look inside of tech, I don't know how geeky you like to do this, but I like to do a top-down analysis. We look at the market, we look at the sectors, we look at the stocks within the sectors. I sort of skip the industries, but that's the breakdown of the market. If you look inside of it, you're going to find a lot of semiconductors doing that. See it right there? So a lot of semiconductors say, well, we got a little ahead of ourselves. Yeah, just a little pullback there as it works its way. Could be a buying opportunity. It could be the end of this uptrend. I don't know yet, but it gives you something to watch. It gives you an area to focus on when otherwise you're like, what do I do? Consumer discretionary is quiet. Healthcare is quiet. I don't know that I want to chase something over here. Utilities a little bit quiet. Yeah, it gives you a place to look at and sort of take all this crazy information and boil it down to, give me some symbols. What do I look at there? So anything in the semiconductor space, you can use SMH to kind of follow the industry's progress throughout each day there. That's an industry-based ETF. Same thing, just nice little pullback. Doesn't really matter where you look in the short term anyways. Doesn't matter where you look. Qualcomm's pulling back, and I use that as a example to say whether it was an underperforming position or whether it was an overperforming position like an AMD, Micron, whatever. They're all pulling back, so gives you something to look at. I also want to point out that when we look at the S&P, we still find ourselves on a valuation basis. So if you're going to look at earnings and earnings alone, just a little bit expensive relative to its 10-year average. And so what's really common is people will look at opportunities to commit larger sums of money to the market when it's discounted. And we use earnings to find out if it's discounted. So we're at about 18 times earnings, just under that right now. And that's just above actually where the 10-year average is. So if your job was to only invest money when you got a discount relative to earnings in the S&P, you're close. You know, you're almost saying, well, I could justify putting some dollars to work, but it's just not quite there for you. Well, you might say, I can't invest in the broad market here because if my sort of operational notes say that I need to get a discount, well, you could look at individual sectors. So we're going to try something a little different here today. Here is where each sector stands relative to its 10-year average. So I'll start over here on the left here. So in other words, real estate is 1.5 times cheaper than its 10-year average. Okay, that's not amazing, but it's, you know, better than nothing. Actually, the S&P just turned negative. Was it today? That includes today. So it is, yeah, it's just under average. So we've got energy just about 1 time earnings below its 10-year average. So yeah, it makes sense. We've got earnings, we've got energy pulling back a little bit. We have real estate pulling back. Financials, you can understand, that went from being about 1 time more expensive than the 10-year average to basically negative now. So I think that's an easy one to explain. You get that there. We talked about materials and industrials, showing you that little pullback with the chart that I just shared a second ago. And that's really it. Those are your discounted sectors if we're going to look at earnings and earnings alone. Is it cheap relative to the earnings that that sector produces on a 10-year average annualized basis, or is it a little more expensive? All the way over here, right? If you were someone of a fundamental investor and you said, I need to have a discount. I don't play momentum. I like to invest. I'm a value type player. I like to see a discount relative to 10-year average earnings. Well, you wouldn't be in tech. And that becomes a problem. Now, if we go to the charts, people that are technical analysts, pick a stock. What was I just showing a second ago? Micron or, AMD. You pick a stock in there and you go, wow, that got ahead of itself. There's actually a lot of names that have done this same thing. So not only did price start to become overbought, but on a fundamental basis, the stock or the sector finds itself overbought. So there's not going to be large sums of money coming to commit. Why would, what's the benefit for a hedge fund or for a mutual fund to say, oh, we overpaid relative to history. We overpaid. That's like saying the car was $20,000. It's currently $22,000 and we're just going to go ahead and buy the car. Yeah, you know what I mean? If prices of cars were that sort of fluid, then, you know, you would make that decision. But so the point that I'm making there is you got tech, utilities, although this has come back a little bit, consumer discretionary, healthcare, tough areas to confidently commit a lot of money. Doesn't mean you can't do anything. It means you're looking over here. So if you start seeing those days, which kind of started today a little bit, I don't know if it finished that way, but it kind of started where people were going for those value plays inside of those sectors. Really kind of fascinating to watch. I just didn't have a great way to share that with you. Mid-cap value stocks all got a little boost today. Nobody cared about them the other day. All of a sudden, they get a little bit of a boost there. So kind of a fun way to point that out. What else do we got? You know, like I said, there wasn't a lot going on there. So I want to point out some of the news that came out today. S&P CoreLogic comes out with month-over-month changes in house prices. Miami, you're seeing that correctly. Miami is the only metro area that didn't see a decline month-over-month in their housing prices. Not that these are horribly bad. These are not large numbers until you get to Vegas and Seattle and some other areas. Miami actually gains 0.1%. Los Angeles, small decline there. Boston, Charlotte, Atlanta. I like to look at Tampa, because that's where we're based here. Small decline in Tampa, not really a big deal. However, we don't care about how home prices month over month so much, do we? It's fun to track like where there may be a short-term pullback. So, for example, as someone asked the other day, you know, should I buy a house? Well, if you're in Seattle, in the short term, you're at least getting some discount relative to where you were. However, most of us are looking at changes over the long term. So if we look from the highest price for each metro area during COVID, how has that changed? Seattle, if you're in Seattle. Now we know that month over month, your prices are declining, but also year over year, you have a 16% discount. I don't know if that like wows you or anything, but at least you're not paying the highest price that you could have paid. San Francisco ranks the worst, 17%. Find it fascinating that over here in Tampa, we were 4. Yeah, there it is. So over in Tampa, we're down 4%. Not a big deal from COVID highs. Tampa's held up really nicely. Miami's held up nicely. Anything, where's Atlanta? Yeah, anything like down here in the South, we've held up pretty nicely. A lot of people have moved into our states and everything. So that's kind of interesting from more of a advisor standpoint there, don't you think? Could be good timing. So you look over here, I'm in Vegas. I was thinking about buying a house. Does that make you happy? Maybe not, but at least you know where you're at from the COVID high. You're not paying top dollar, or if someone's asking top dollar for that house, you might think twice about that. All right, let's just go back over here real quick because I sort of bounced around. S&P, obviously a snoozer of a day, not too much to go on there. NASDAQ, a little bit more of a mover. That's because of your semiconductors pulling back on the day. The Dow was basically flat. It actually finished the day almost perfectly flat there, 0.1% to the downside. That's not going to do anything for anybody. If you look at crude oil, obviously the rally continuing there today, you'd expect that this is around the area where we're starting to sort of familiarize ourselves with a low. I don't know that you see oil breaking through that low. It's a tough one. Bonds pulling back a little bit more. There's just not much to say there. Rates obviously go higher when prices go lower, but we're still within this range. And nothing really to write home about, at least in the last couple days anyways. Yesterday, we covered the financials. We said, wow, there's some really interesting time periods in history that are really correlated to the way financials are performing now. Really, really close. So I said, well, that was one example, and it was pretty obvious what happens after that correlation, and that was with every one of them, take out COVID. I said, well, what's the sector that offers some correlation to history at the moment? Let's find those, and then let's see which sector maybe doesn't have such an obvious outcome. So let's try this on for size here today. Here we're looking at the tech sector. So if we look at tech, January 2004 to January 2005. We're going to do this just like we did it yesterday. We are 72% correlated to that exact movement. In other words, 72% of all days are behaving exactly like it did in 2004 and 2005. February 1991, 92, same thing there. And then not too much further, you got February 92, 93, and January 2001 and 2. Those are the 4 most correlated times in history over a 1-year period that are behaving just like the tech sector is now. And if you want to look, you can say, I said that wrong a second ago. This is your most correlated. It was 92, 93. So anyways, the light blue is what we've got going on right now, and dark blue is what happened in history. Isn't that fascinating? The lows almost marked on the same exact day. The pullbacks almost marked on the same exact day. Rallies ending at the same exact day, and then pulling back and stopping on the same exact day. Fascinating to see this stuff, because more often than not, it's not just that this is because it's correlated. And I hope you get that. And nobody seemed to misunderstand me yesterday. It's because the time of the year we're in. It's because of the distance between earnings finishing and earnings starting. You see what's happening in here? There's a lot more to go on than just saying, show me a market that moved just like the market's moving now, or show me the tech sector time that's moving just like the tech sector's moving now. Here's where the trouble comes in. There's not much to, be super comfortable about. If we look at the forward performance of every other time, those 4 times that we were the most correlated there, not all signs point up or down. So this has the lowest probability or the lowest forward accuracy of any sector relative to what the other sectors, and of course what we talked about yesterday. Financials has the highest forward accuracy, meaning all 4 lines are closer together than further. That's kind of the fancy way to say it. I'm sorry, the simple way to say it. But tech, you got nothing to go on. You got some higher moves, some lower moves here. The spread between the highs and lows is too much. It is a low probability trade to assume that low probability investment to assume that when tech correlates to at least 4 or more other times in history, that something's going to happen. right? So yesterday I gave you the obvious one, the really clean, crystal clear one, and I said, well, let's do one today that makes it, makes it real, right? That this is just not some magic sauce that you can sip on and everything. So I thought we'd have fun with that. Yesterday, we did cover the financials, so if you want to learn a little bit more, get a little more in-depth look there, you could do the same. We've had some great wine and wealth classes over the last couple of weeks. We're going to continue doing that. That'll be Thursday this week. I'm going to expand on what we did last week. We talked about just an incredible amount of data. It was so cool how to show performance relative to when you make decisions to be in and out of the market without, cherry picking good and bad and making it look fun. So that's really cool there. And Thursday, 8 o'clock will be another one. Jazz After Dark here tonight. We're going to talk about returns after market moves, and we're going to bucketize each move in the market. And I'm going to go through and see, is your mindset the same? When the market has an amazing move up in 1 year, is your mindset the same as what happens the year following? When the market has a big drop and it's just crazy chaotic, do you behave the same way that the market tends to perform afterwards? So we'll have some fun with that, because I bet you you're not on the same page. Who was that? Who used to run around saying, I bet you? It was like an SNL skit or something. Remember? I bet you.
Yeah, well, there was a
It was a
YouTube
lady.
guy.
Who?
No, never mind. I'm mixing it up.
You don't know? Someone will tell us. I forget. Oh, it was a while ago, but haven't watched that in a while. Yeah, so Jazz After Dark tonight at 7 o'clock. Reminder, there'll be no show tomorrow. We're going to be at Sun and Fun. If you're out there and want to say hi, that'd be cool. We're going to see a few clients and such and maybe get a little suntan. So we'll see. Hopefully the weather is good. All right. Stocks in the news. I'll take your questions. Not a lot of news. You could have easily said, well, then I'll dig deeper. Alibaba is going to have now like 6 Alibabas. They're going to just split the whole company into 6 pieces there, partially due to Chinese regulation there. They can ask a company to do that, and they have to do that. But you could dig into that deeper. You could have read into what's happening and forced yourself into maybe buying or selling or doing something. It's just a light news day. Lyft. One of their former board members is going to be the CEO, and I didn't write his name down. It was David something. I don't know him. I haven't studied him or anything, but maybe he can make them profitable. All right, PVH, Ralph Lauren and such, fancy clothes, better than expected earnings. You guys are buying the nice clothes. This is like the Calvin Kleins and all that stuff. You're buying them. They're doing well, so much so that they said, we think this is going to continue. Our guidance going forward is strong. We're staying. We're going with it. More people are buying it. They're not running away from the fancy clothes and underwear. Walgreens actually had earnings come out. Same thing. It was good for them. This is an example of one of those value discount type plays that got bought up today, but that's earnings related there. And lastly, you got McCormick, the one you're thinking of. That's what they do. Spices and whatnot. McCormick, better than expected earnings, all good. Basically, every earnings report that came out today either beat and raised guidance or beat and kept their guidance going forward. So you got a lot of good moves there. Just those were the bigger names. There's not much else to say. I sort of fill in time at this point. Intel had their investor day, not too much going on there. And tomorrow you have Paychex reporting earnings. And really, that's it. Cintas also will report, but it's not like a market mover or anything, so I don't expect that to make any headlines. All right, I'll take your questions if you have any questions, and then if not, I will get on my way. No rhyme or reason to support anything in these markets. Have zero good news. And really, like, not a lot of news generally. Kind of a quiet period. And so that's why I chose to use today as, well, if you had to do something, or if you were just wanting to do something, where do you look? And can we break it down by sector? So I hope you enjoyed that. In your view, what are the chances we go into a recession? Technically, there's a 100% chance that we go into a recession within 2 years, and that 2-year window would have started 8 months ago. So that's your stats there. I thought about bringing that today and doing something there. We can. It's a little bit geeky looking at the yield curves, but I was trying to find a way to lay them all out. So every inversion of a yield every yield curve inversion of different pairs. I was going to actually try to figure out and show you when these invert, 100% of the time we go into a recession. When these invert, 100%. When these invert, 95%. If I can figure how I want to show that, I'd be happy to do it. Yeah. Gonna wait till banks' earnings to make any moves there. All right, you don't have to wait too long there. Yeah. Nice. Well, I appreciate that. Hitting the like button there. Micron's earnings give a clue into semis. Absolutely. Yeah. Absolutely. That is what we have to look forward to, assuming there's no news until then. Hopefully something happens there. Yep. You saw the news in Reuters today. Global bank warns lost decade in global growth. I believe that's probably the 4th or 5th time they've done that. And I'm not making that, I'm not trying to be funny. Vanguard did that about 4 years ago. Then they did it 2 years ago. So, yeah, I don't know. It's like every year we see the same thing. So I don't know. I do expect that on a really, really zoomed out level, we're just going to be bouncing around. We got way overextended there, way too fast. Yeah. Which data point carries more weight for future performance? Last year's performance or the Fed stops raising rates? Well, the Fed stops raising rates always will, or any rate decision is going to impact the ultra short term. So if we're talking short term, you're going to go with the Fed. If they literally came out and little by little, these little guys start coming out. Who we have today? Barr? I think Barr came out today. Yeah, one of those guys. But if they start coming out little by little going, you know, maybe we could pause. I guarantee they will not just have the next Fed meeting and say, we're pausing. You will know leading up to it. They will come out and sprinkle their little words little by little. It's not conspiracy. It's how they like to do it. They consider that being transparent. They've said that themselves, not me. And so we will know going into it that is likely the chance. Think about looking backwards. There's always been a really clear indication. Is it a quarter point? Is it a half point? Or is it more than that, as we've seen sometimes? Need the housing market to flatten out till the close on this deal, man. Well, Dustin's trying to get his dollars there. All right. Well, I will wish you guys a great rest of your day. I'll put this back where I found it there. Remember, we will not be here tomorrow. We will be at Sun and Fun. First time in 18 years. I'm looking forward to that. So if I see you out there, I see you out there. You know what I mean. I'll just be wearing the same shirt, man, every day. You guys enjoy the rest of your day and enjoy tomorrow. We'll see you again on Thursday. Have a good one. Thanks for watching.